Hey, everybody. Welcome back to the 4-Star Wealth Today's Market Explained podcast and video series. We have, I call the home team back with us today. We've got our own great economists in the Reno office of Universal Value and 4-Star Wealth right in downtown Reno, which is the boomtown of America right now. We have Bob Barone, Fed level economist. We've got Josh Barone as well, his partner and chief investment officer of Universal Value Advisors. So welcome, guys.
Glad to be
Thanks
here.
for having us.
All right. So we've been on a bunch of different discussions lately about what's going on in the economy. And Bob, your pieces in Forbes have been pretty clear. We're in a recession. Inflation's slowing down a little bit, it seems. Do you want to just give us an update on what you see right now about the economy? I think everybody's very curious.
Sure. So as we sit here, we've experienced the worst 6 months in the equities market since 1970. And that's after a bear market rally in May. So not a really good equity market. In fact, in June, the equity market was down another 8%. And the reason is pretty clear. The incoming data are deteriorating. So, for example, quarter one's GDP, which came out originally at minus 1.3%, is now at minus 1.6%. And as of Friday, that was July 1st, the Atlanta Fed, this is one of the regional Federal Reserve banks, they have a model that's been pretty accurate, and that model says that quarter two's GDP is going to be negative also at minus 2.1%. Mm-hmm. The New York Fed's model says there's an 80% chance of recession. Now, usually when these Fed models get above 50, that means it's pretty well baked in the cake.
They're pretty serious.
Yeah. So a recession is really defined by the National Bureau of Economic Research, but they meet only occasionally, and sometimes it takes them a pretty long time to determine the dates that a recession begins and ends. In fact, sometimes they don't determine it until after it's over. So the markets use a rule of thumb. The rule of thumb is, if you have 2 quarters in a row of negative GDP, you're in a recession. And in fact, that 100% of the time that we've had 2 negative GDP quarters, we have had a recession in the post-World War II period. So the incoming data is pretty bad. We can get into it later. I would also say that the media continues with this narrative on inflation, and the Fed is looking at inflation and the employment, and these are lagging indicators. What they should be looking at is what we're looking at, which is commodity prices, and they're falling rapidly. Even the price of oil got under $100, I think, yesterday.
Yeah.
Josh, you have anything to add?
Yeah, I would add, again, we talk about recession. Again, we're saying we're in a recession. We've been saying that for a little bit. And you could say 2 quarters, but you could also look at it and say when the forward earnings are starting to roll over, meaning they're starting to go down, that's a significant sign of something. That being said, the depth of the recession is really going to be dependent on the price of oil, because you had an oil shock recently with the Ukraine, and oil shocks tend to bring recessions on their own as well. So we were in a recession, going into recession, and then we have an oil shock on top of that. And so I don't know. I paid $5-6 the other day for gas in my car, and I think it was like $130. But think about oil is pretty much in every product out there, and so that should significantly slow down. So as oil stays high, and if it stays high, then I would say, and I think we're saying that the recession will get deeper and deeper. So while we're talking about recessions now instead of inflation as a narrative kind of shifted 2 weeks ago. There's really no talk about how deep the recession is yet. And it's remained to be determined because, again, as the data comes in, we'll know more.
Yeah. Well, it's interesting. I saw an exchange between some of the reporters and the White House spokesman that now oil prices have receded about 15% from the high, and yet gas prices are down only 3%. So that's a natural lag, isn't it? I mean, it doesn't seem like they immediately lower gas prices.
There hasn't been a refinery built since the 70s. So you're talking about oil prices on the world market versus refined fuel prices. There is a problem in this country based on there's just no refining capacity. And so that's part of the problem there. But again, some of the problem, you'll laugh at this, some of the problem is just that the baby boom generation has so much money that they've been chasing contracts in the commodities markets. You and I both know that commodities have been the place to be this year. And again, when they see some place to make money, they tend to run in. And so I think some of the run up in commodity prices is speculation. I would say a lot is actually. So if some of that speculation came out, we might see what the actual true demand levels are. It remains to be seen. So naturally, you would think that oil prices would move back somewhat off the shock level. Where they fall at this point is kind of everybody's guessing at it.
Sure. Now, what about real estate prices? We just saw a galloping price surge in many markets. Even the secondary markets that weren't doing very well started to do really well. And then there was almost like a dead sound about a month ago, where transactions collapsed, prices started to fade, first time in a long time. It's a scary time out there. What do you think could happen, you guys, to Bob or Josh, either one, to real estate prices here? Is going to be a major collapse, or it could be just a little fading?
Well, we don't know exactly what's going to happen, but we do know that the prices are starting to fade. There was a headline that I read recently that said something like, builders are slashing prices to sell houses in quickly cooling markets. And that I think one of the statistics was that in Phoenix, 22% of the new listings between early May and early June had the price cut. So we're beginning to see some cracks in the housing market in the U.S. So I don't know if it's going to be like '08, probably not like '08, because we do have a housing shortage, but we're going to definitely see prices stop rising in the housing area. Besides that, what we're also seeing is that new homes aren't selling as fast. I think in Dallas, the inventory of houses under construction is twice the normal level, which means that GDP is going to be impacted because new home construction is a big part of GDP. So I think that housing is going to cool. I can't say it's going to crash, but I think definitely it's going to cool.
Yeah, interesting. And I've been trying to figure out why so many economists are saying, well, we're maybe going to have a recession, but maybe not till next year, and things like that. And the only thing I can figure is that they keep looking at employment numbers being a little stronger than they normally are as we enter into recession. That's like pandemic recovery situation. But I'm loath to figure that out. What do you guys think? Why are there economists out there still saying, well, maybe there won't be a recession?
Well, the answer is pretty obvious. If you work for a big brokerage firm, you'll never be fired by saying things are good.
Okay.
So they hesitate to say recession because of the client base.
Mm-hmm. Right. Well, and of course, we know the White House does that because they want to keep everybody happy. It's an election year. But as you said, it's most likely here. Well, what else are we seeing out there that we should be concerned about? I know, Josh, you've done a lot of work on international markets, and looks like Europe is collapsing now as well. Is that right?
So Europe's fairly interesting because you have the ECB just announcing rate increases. So it seems like they're a little bit behind. But don't forget, I mean, they're so reliant on Russia for oil and gas that their inflation rates are through the roof. And so on the announcement, what I found really interesting on the announcement was that all of a sudden you got these splinter countries and their rates kind of blew out. So what's that mean? So Italy and Greece, who are part of the EU monetary union, their 10-year rates were going up significantly on that announcement, why Germany's were not. So the ECB came out and said, hey, look, we can't have splinter countries, splinter factions in our union. And so why they announced QT, they're essentially having to buy Italian and Greece bonds and then sell essentially German bonds. Now, from a credit quality standpoint, you don't really want to do that. But again, central banks don't care about credit quality. They're essentially in a rate management, curve management situation. I think the other thing that's interesting is that Germany came out and had really bad GDP prints. And so it looks like the whole area is slowing down massively. When we talk about these things, we're essentially looking for some kind of liquidity break, because essentially a liquidity break will cause our Fed, to move in the opposite direction than where it is now, which is extremely hawkish. And so I think in every time the Fed put has been in place, there's been a liquidity problem, and that's what's really caused that action. So again, as we're Fed watchers and we're looking to see what they do, we're very, very interested in liquidity lockups here and where they occur and whether they cause the Fed to change its stance.
So the Fed said they're going to keep raising interest rates, but it looks like the market's predicting that they're not. Is that what you're getting?
Yeah. So beginning about a week and a half ago, the bond market, which is always the first one to see things, changed its mind about inflation, and bond yields began to fall. I think we had bond yields the 10-year go from like near 3.5% to now like a 2.9%. in a 2-week period. That's big time.
Big.
And it means that the bond market doesn't see the Fed completing its forward guidance. What is forward guidance? Forward guidance is that thing called the dot plot, which is a plot of where each committee member sees interest rates going over the next 6 months, year, 2 years. Okay, and so they show these dots, and they've showed the dots since 2012. By the way, the correlation between the dots and what actually happens is under 40%. So it's not a very good predictor. Anyway, to get back to the story, the bond market has seen that the Fed probably isn't going to fully enact its forward guidance. Now, we won't really know until we see the next set of dot plots, which only occurs every quarter. So the next one will be in September at I think the meeting is mid-September. So after that meeting, we will see the new dot plot. I suspect it will be lower, okay? Now the Fed minutes came out today and were very hawkish, but don't forget, those minutes were from a meeting that occurred about, 2-3 weeks ago. And since then, we've had a lot of negative news, especially news around what is going to happen to inflation. Now, what do I mean by that? Well, and the Fed is very hawkish because inflation is high. And we're probably going to see another high number for June when it comes out, I think next week, early next week. I suspect it won't be as high as May, but it'll still be too high. But beginning in July, I think we're going to see big down spikes in inflation. And why do I say that? Well, all of the commodity prices have been falling. For example, I had some somewhere. Wheat is down like 30%, copper's down like 50%, and even gasoline is down 15%. Now, as Josh mentioned, gasoline's an issue because refining capacity isn't there. And refining capacity isn't there because the refiners have to make an investment in refining, and to build one of those is a fortune. And
Right.
they need 20 or 30 years of business to pay for it. And they don't quite see 20 to 30 years of rising gasoline demand because of the move to electric vehicles.
Right.
So it's a current issue. There's not enough capacity. So gasoline is likely to remain elevated, but the rest of the stuff is falling. And consumers are changing their habits. They're not buying as much food, even at the grocery stores. They're not going out to dine as much. They're not staying at hotels. Now, when I say they're not, these are marginal changes to the downside that we're just seeing now.
Yeah. So consumers slowing down, businesses slowing down, we're in a recession. So what are the opportunities from an investment standpoint that you guys see right now? Either of you chime in, offer your thoughts on that.
Let me ask you a question. So what was the best position to be in from the beginning of the year, hindsight being 2020? And some people will say commodities, oil, but short the NASDAQ was the best position. So
that was the highest return, short the NASDAQ.
Yeah. So will these kind of short trends in the market continue? Yeah. When we look at it, so you could say that the PE ratios are coming into some kind of normalcy here, but you're just seeing the earnings roll over. So, the corporate earnings have been strong for 10 years and they were and they're peaking right now. They're the best they've ever been, which is good for corporate balance sheets. But however, they're just rolling over now. So you're starting to see inventory issues. I think everybody saw the Target inventory. I think they have $15 billion worth of inventory. Best Buy, Walmart, Amazon, Nike, to name a few. They're all citing overages in their inventory. What else is funny is that the LA port just noted that it had the third best record delivery of goods through the port in history. So not only are they over inventoried, they have more inventory coming. And so that's for things that you want, that's deflationary. So things that you want, if you want a new TV, you wait a couple weeks, right? Or a couple months, and you should be able to get that TV at a pretty steep discount as they're trying to move inventory.
It seems that way. That even the retailers are talking about that. There's going to be a lot of sales this summer. They couldn't have planned this, and took so long to get the inventory that they weren't prepared for it when it finally came.
So you're going to get essentially a purchase manager strike. So you're starting to see the PMI numbers roll down here and in China. Don't forget, we buy mainly Chinese goods now. And so you're starting to see them not purchase. And so they'll have too much inventory, they'll discount, and then we'll go back to this idea that they don't have enough again because they essentially went on strike. So I wouldn't think that you'd want to be long retail here as it bounced around with volatility in terms of, and the consumer in this market is getting very, very tapped. Credit card usage is way up, and overall debt is high. You can't refinance your house now because that credit card has been kind of taken away as interest rates are now above 5% for 30-year mortgages. So what is a consumer to do? Well, there's a couple things they can do, and one of them is not spend. And so that's looking like to be one of the bigger areas of problem. But from an equity market standpoint, there'll be a point when the Fed capitulates, and that'll be a time to get back in, and you'll want to put risk assets on. As don't forget, the markets are a discounting mechanism, so they're looking typically 6 to a year to 5 years forward. And so there'll be a point before the recession bottoms here where you'll want to put risk assets on. Now, I don't know exactly when that is, but I don't think anybody's talking about how deep this recession is going to be. And until we know that and see how much earnings power do they lose, these corporations, will we know the depth of that recession? And so I would park on the sidelines in terms of equities. Now, bonds are a different animal, and I'll let Bob talk about bonds.
Yeah. Yeah, tell us about bonds. It's been the worst bond market ever in American history, the year to date. So you guys are bond managers, and I'm sure you felt the pain. So what's the prognosis?
Well, this is most dangerous 4 words for an economist to say. This time is different.
Oh, yes.
And I'm going to say that this time is different when it comes to the Fed and to bonds, because 1, the Fed has never, ever tightened into a recession. They usually loosen.
Yeah.
2, this time is different because in the past, the Fed, when there was a recession coming, the Fed never, ever talked about what they were going to do. So in the Greenspan era, I remember the street looking, how thick is Alan's briefcase? If it's thick, it means they're going to do something or other. Okay.
Yes.
They never talked. So this time they're all talking. And this time we have the quote forward guidance, the dot plot. We never had that before. So what happened was when the Fed decided to tighten back in January, February, March, and they issued the dot plot, what the market did was tighten to the extreme end of the dot plot all at once. So what the Fed said they were going to do in 2 years, the market did in 30 days. And so that's why we got to a 10-year note yield of 3.5%, because that's where the Fed said they were taking interest rates. As Jai said, well, when do we know when to put money back into risk assets? The answer has always been when the Fed changes policy. Well, what exactly does that mean? Do they have to get loose again? And the answer to that is no. It's when they tweak it. So it's, in mathematical terms, it's called the second change or the derivative. Okay. So so here's an example. If at the July meeting, where they're expected to go 75 basis points, they only go 50 because now some of their 400 economists see what we see, and that is a slowing economy and trouble ahead, and they only go 50. The market was expecting 75. That will be a signal to the stock market that and to the bond market that they're going to start to ease as the recession comes. And that's the signal to get in.
Interesting. So the stock market could continue to correct, and then we'll get some signals when the Fed changes. So maybe the Fed can't raise interest rates at all anymore. I mean, they're saying 75 basis points in July, but maybe they don't do anything. Or do you think they're scared enough with what they've created?
So you hear a lot about inflation and stagflation, and this is important to your question here. So stagflation is essentially inflation and a recession occurring, and then 70s stagflation had high unemployment as well. Right. So the beauty of where they are now is the unemployment is the lowest, I think, in histories. I think you have to go way, way back to find a lower unemployment rate. They have the ability to raise into that and allow that percent to increase. So unemployment can increase 2 or 3%, 4%, and still be extremely low for this country. And so they do have that ability. So if you were going to ask me if they have the ability to raise interest rates, I would say yes, they have a lot of ability to raise interest rates here. And in fact, I would think they would probably overshoot it because they're so worried about entrenched inflation, and especially in the labor market, that they're willing to slow everything down to make sure of that animal does not exist. Now, when we look at the markets, we don't really see entrenched inflation. We see a lot of supply side inflation, a little, and some energy and food inflation, as again, there's been a supply shock in the form of Russia invading Ukraine.
Right.
Now, I saw a thing from Jeffrey Rosenberg basically saying that if they did nothing from this point, the supply side would essentially fix it and bring inflation back to 2%. Do I believe that? Yeah, again, we think that essentially that inflation is transitory, except the Fed could not stay on target because the media and the political bodies would not allow them to do that because of fear of entrenched inflation. Bob, you want to add some?
Well, you're right. So we have inflation as the biggest issue in the country. Problem is the Fed is looking at the backward data. They're looking at the unemployment rate, and they're looking at the CPI. Both of these are lagging indicators. They should, as I said at the beginning of this, they should be looking at the leading indicators. They should be looking at the fact that the markets see all of the commodity prices in backwardation. What that means is the markets see commodity prices down in the future, all of them. And that what they should be looking at is housewives or women going back into the labor force. And we're going to see, and we see that in the early stages where we're seeing spending on health care for old folks going up, putting old folks into nursing homes so they can go back to work. Those kinds of early indicators are that women are coming back to the labor force after staying home during the COVID. So we're going to see the unemployment rate rise probably into the 4% range from 3.6 where it is now.
Okay. So if inflation is transitory, although not as quick as the politicians said it would be transitory, that would mean that if all these supply chain issues and other things are solved that were caused by the pandemic, then eventually it will go right back down. It's firm, kind of baked in inflation that can't come down. It will come down, right? And it's really just a functional factor as to why it was created that way.
So, one thing you have to look at is that COVID created a behavioral shift in consuming. You add the fact that the government was giving out money left and right, you kind of created a consumer boom there. And again, the behavioral effect was from brick and mortar to on-site retail, web purchases, right? Right. Mainly the web goods come from China. So you had this massive amount of goods trying to go through our ports during that period of time, and the ports got clogged. Now, as we shift and go back to brick and mortar a little bit, as there's that behavioral, now it won't completely shift back, but some of it will. And that should solve some of the ports problems, issues there, that's supply side. There's a funny economic saying, and you've heard me say this before, Brian, but what's the cure for higher prices? And the answer to that is higher prices.
Right.
And so, again, you're seeing that too. So as inflation kicked up, the higher prices have now entrenched some spending. And so people just aren't, when I look at even the 4th of July this weekend seemed much, much quieter than it had in past years, as what I believe is people just stayed home and barbecued in the backyard versus taking a trip where, it was going to cost them $500 in petrol. So you're seeing a lot of entrenchment in that term, in terms of purchases. That helps the supply side too. So as that occurs, and again, there's port expansions and everything else going on, so that when we go back, as we keep on buying more and more stuff on the internet, they're able to handle it. Again, supply chains take time to fix. It's not something that you can fix overnight. The problem with our society is that patience doesn't exist. Patience is waiting 2 seconds for that tweet to hit your box, and then the truth comes out. But in reality, transitory is, call it a year and a half. And if we go back, it's kind of where we're at. And it seems to be, why the Fed has changed course on the language, seems to be where things have been. So, it takes 15, 16 months for this stuff to work itself through. We're about halfway through that.
Yeah. Well, there's a lot of weird things that have happened to this economy because of the pandemic and COVID and everything else. And so, of course, naturally, that was the that was the event that was blamed for all this by certain people. But one thing that's definitely true is the labor force participation rate is at all-time lows. And that just means people are not in the workforce. They haven't raised their hand in the proverbial, yeah, I need a job and I can't find one. So have we just developed bad habits in our country where people have decided I like sitting at home and I'm just going to stay here? We have labor shortages everywhere, low unemployment, yet people aren't working.
So let's talk about the labor shortages.
Yeah.
So just like everything else, when you hear about labor shortages, if you're a business owner, you hang on to your employees and maybe you try to hire some more. So that's what we've seen. We've seen what I call labor hoarding, and it's overhiring, and it results in a productivity number that's a negative. So we've seen the largest negative productivity number in last quarter at minus 7.5%. That's the highest since, I think, 1947. Okay, we haven't seen a number like that. What it means is exactly what I said: labor hoarding and overhiring. Well, when the corporations see that they're not making as much money, which we're going to start to see this quarter, they're going to start laying off.
Layoffs, right.
And we're going to see the unemployment rate go up.
Okay. So then it'll normalize to what
Sorry, to add to that, structurally, this country has a populace that's on the older side. So somewhat like Japan, where the populace is older and kind of dropping off that workforce, but they're in need of services. Again, I think we talked about medical services being a big kind of area that is in need. In fact, I know nurses are in short supply right now as well. The lack of immigration policy in this country is somewhat problematic. That essentially we're not bringing in as many immigrants as that we'll need to keep our labor pool large. And I'm not talking about poor immigrants. I'm talking about high skilled people too, especially computer engineers, that kind of thing. So without a clear immigration policy, there's just no way to combat that. And so we do have this dichotomy of this generation that's really large coming through, and the services. So structurally, you're going to have low unemployment. That being said, some of those resources will ease up as some of these things play out. But again, without good oil policy and good immigration policy, we're kind of in a conundrum.
It really seems like a mess. And now we're seeing, we're going to see over 2 million people coming through the border. And now there's talk that the third quarter will be even more than that. Can that have any implications for our labor market? I mean, these people are generally unskilled. As you said, they're not really the right people for the job market, but will that change much, do you guys think?
I think in the construction industry, I mean, I'm acutely aware because I'm doing things to my house, but there's been, when I talk to the contractors, essentially there's no labor. They can't get anybody skilled or non-skilled. So they're willing to accept lower skilled people just to put a body on a job so that they can keep their clientele happy. Right. Maybe as that slows down, as again, the inflation pressures there are immense in terms of gas and goods, that some of that labor pressure will ease. I mean, that's what we can hope for now with the change in the immigration policy from the Supreme Court. Will that bring in low skilled workers? Yes. But don't forget the administration put a thing that if you take $400 out of your account, you have to tell them why. And so as we go more and more to digital currency and the less of that undermarket in terms of cash for labor goes away, I just don't see it really putting a huge dent into the markets, labor markets in that fashion because of that.
And there's going to be a lot of battles over who's legal and who's not legal and who has a green card and so those people will be a problem for the country, but it probably won't show up in the economy.
Correct. I think in Europe, if you look at when a country reports GDP in Europe, they actually account for the black market. And so I don't know if that'll happen here, but essentially they say, hey, this is how much economic activity was in the black market, and they include that in their GDP reports, which is kind of funny. I don't know how they figure that out, but they do that.
That's funny. Well, yeah, we haven't done that here yet. Well, so we had the worst stock market to begin since 1970. We've had the worst bond market in a long time. We're seeing real estate rollover. Now, the opposite number would normally have been real estate. That's fading. Now we've got gold really not doing much. We've got silver kind of fading, and Bitcoin, which was supposed to save everything, is now about 20,000 a unit, down from 60,000 a unit. What do you think about all that? I mean, is there anywhere to hide from these rough markets, and are there opportunities there?
Well, the fact that gold and silver are falling in price indicates that the market doesn't see inflation.
Yeah. Okay.
So, and I think I noted that the inflation expectations are on the downside now as you go forward. So in terms of Bitcoin, I would say it's definitely something that looks like it's blowing up, but they have regulation problems in terms of a spot Bitcoin ETF. I can't understand why they're holding that up, but I did hear that it didn't get approved today for some reason. But as I look at the Bitcoin market, as it's more accepted in futures contracts and all this other stuff, it will become more stable. But you're in a market, and I'm not going to go to the underlying fundamentals of what it actually is, but you're in a market that's, in maybe the first half inning of what it might become. Now, the tech, I'm not talking about the coins themselves, but the tech, the blockchain tech, has a lot of uses going forward. Now, will it come out in the current form? I think that that form will change, but and maybe the coins themselves maybe fade away, but you can't deny that the blockchain technology is real and has practical uses in the future.
Yeah, so it is interesting, but it just seems like nothing's working here. And I think you're right. That's the signal. Inflation is probably going to fade, and it is probably transitory. Wow. So we've covered a lot here, you guys. I mean, what else? What else should we be considering here? I mean, in this very, very strange kind of unforced error economy, if we can call it that.
So I would say that all of the leading indicators are telling us that the recession is really going to be deeper than anybody expects today. For example, the University of Michigan has published a consumer sentiment survey since the late 1940s. And they have an aggregate number that they put out. The aggregate number is the lowest today in history, lower than any that preceded any other recession. So that tells you that the consumers are very concerned about what's going on, about the inflation. Now, one of the things I will say is that most consumers today didn't live in the 1970s, or if they did, they weren't old enough to remember inflation. And so this inflation is a shock. I mean, when you go to the grocery store or you go out to a restaurant, the prices aren't up 8%. The prices are up a lot more than 8%. Mm-hmm. And so the CPI is probably on the low side. And consumers recognize this. So what they're telling us is, we're not going to buy cars. Okay, we're not going to buy big ticket items like appliances, and we're not going to buy houses. And those are leading indicators, and they've always been leading indicators. Unfortunately, the Fed is watching the lagging indicators. So that means when they act, they'll be too late to stop the recession, which we think is already here. So it is already too late. Yeah. But so that's where we see it. But when the Fed, as I said before, when the Fed changes policy, that's when the markets will turn. That's when they've historically always turned in the post-World War II era.
So
let me add this. So the other thing that people I hear out there that the Fed has I've lost confidence in the Fed. They don't know what they're doing. They don't know what they're talking about. They said inflation is transitory. Obviously, it's not. And so there's no confidence in the Fed. And I would say it's quite the opposite. There's so much confidence in the Fed that the Fed didn't do anything. They just essentially put some dots on a piece of paper, and the markets moved interest rates, the biggest move in history. And that's why you're seeing the bond markets, kind of where they are in terms of performance. But what we're not talking about is that fact that interest rate move is so large. It's like driving a Maserati 100 miles an hour into a wall. They moved interest rates so fast that's kind of what we're seeing, and you're seeing that starting to show up in the data, and that's why we're seeing, hey, this is the biggest number in history in terms of consumer confidence. But there's other things that are like that as well, and it's because of the overconfidence in the Fed in terms of their forward guidance and what that has done to the interest rate markets. I mean, if you're lay, just look at the interest rates in the 30-year mortgage. They're up 3% in 6 months. That's not a small percentage. And when this stuff used to happen, before Bernanke, they would inch up, and the market didn't know exactly where they were going, and so they would just inch it up, right? And they're trying to use that same policy, but again, with their speak is so powerful now. They have so much credibility that they've been able to do this. And so the slowdown that isn't a normal type of slowdown. It's going to be very rapid and very extreme.
Mm-hmm. Wow. Well, we'll see how it plays out. We hope for the best. We hope for a mild recession. If we get a bad one, that'll create opportunities, and we'll see what it looks like on the other side, you guys. Anything else you want to share with us before we end it for today?
And the other side's going to be in 2023.
2023. Okay. So let's look for opportunities then. Maybe the markets will bottom in the fall. Economy will start growing. We'll see, right? So, all right. Well, great, guys. Well, thank you for being with us, and we'll check in with you, and maybe in the fall again here to see what you think then, and if it's played out as the way we thought it might. And really appreciate you being here, and appreciate you being part of our group with 4-Star. Appreciate that very much.
Thank you.
Well, thanks for having us.